for an Iranian attack over the weekend, what you had was a major sell-off already take place on Friday afternoon. So you saw the US stock market, the S&P 500, for example, that had its worst daily performance since January. And similarly, people ran into havens like the dollar. It had its best week in 18 months. And conversely, markets are already priced in that news over the weekend. And when you get to Monday, where we are now, actually, there is at least some degree of relief. Of course, there's still caution, but there's some degree of relief that basically we haven't seen an even worse outcome, at least so far. There hasn't been any further direct missile strikes in Iran and Israel, and the US have certainly sought to caution things and said they don't want to see a further escalation.
Yeah, so it's the old market phenomenon of travelling rather than arriving.
Absolutely.
What about the equity market? So again, I mean, we saw Asia sell off overnight. That was really, I guess, because Wall Street sold off so heavily on Friday evening.
Absolutely, that there's some degree of catch-up, that it wasn't until about kind of 1, 2 o'clock London time on Friday that the headlines came through that there potentially was going to be a serious escalation in the Middle East. So it was exactly at that point you can track the sell-off. And actually, when it comes to equities and the reaction to geopolitics, one thing that we found in our framework is that for countries that aren't affected, so outside the immediate Middle East, actually the pattern that markets tend to have in response to geopolitical events, and we saw this similarly after Russia's invasion of Ukraine, is that you tend to get quite a short, sharp sell-off. So, for the first 3 weeks or so, things can tumble quite a bit, but actually things also bounce back quite quickly. Ultimately, it's macroeconomic developments like growth and inflation that markets trade off in general more than geopolitics.
So you mentioned inflation there. Obviously, oil is pretty pivotal to that. Where does inflation go if you see a re-escalation of hostilities?
So certainly the risk is that it's going to head higher again. Particularly that risk is elevated because inflation has already been above target for 2 to 3 years, depending on the country, and inflation expectations are pretty elevated right now. And actually, I think the biggest risk is not just what happens to the oil price, because people are factoring that in to some extent, but the biggest risk is what economists recall second-round effects, which is basically where, oil prices go up, for instance, but because firms like supermarkets, for example, use oil, have energy costs, they then start passing those costs on into other goods and services. So actually, what you can see is that you get an oil shock, and then other prices start to rise as well, which is how that inflation becomes more broad-based, more concerning, the sort of thing that central banks would need to react to.
And not just oil. I mean, we've seen some big moves in metals prices lately, copper, aluminium, largely on the back of Chinese demand picking up.
Absolutely. And one of the good news stories so far this year is, there was a lot of belief that, particularly last year, that the global economy, particularly big countries like the US, were headed for some sort of hard landing, particularly given that you had the most aggressive series of interest rate hikes since the early 1980s. But as that hasn't happened and people are becoming more optimistic on the overall global demand picture, actually we're seeing demand for industrial metals go up. And also, given events in the Middle East and concern about inflation, precious metals have gone up as well. So you've got that dual force acting as a positive catalyst.
Obviously, we've had a real repricing of interest rate expectations over recent weeks. Presumably, if you do start to see primary inflation starting to pick up, I mean, that's even more reason for the Federal Reserve to sit on their hands.
Absolutely, and a consistent story of the last 2 to 3 years has been markets have consistently got really hopeful that interest rate cuts are around the corner, yet the timing of that keeps getting pushed back and back and back, and this is a familiar story. And I think one thing that's happening, and you often see this in response to big market turns, is that since the pandemic, we're in kind of a new world, a bit like we were after 2008. And just as after 2008, people all expected interest rates to kind of go back up quickly, and they didn't, we're seeing the reverse now. After the pandemic, people are expecting that, we're going to go back to the world of the 2010s, the last decade and a half, interest rates are going to come down again. And I think there hasn't been enough of an appreciation that we're now in a new normal. Inflation is higher, geopolitical risks are elevated, and interest rates are likely to stay higher for longer.
All right, Henry, we've got to leave it there. Good to talk to you this morning.
Thank you, Ian.
Some other business news stories for you now. And the international motor dealer Inchcape has sold its UK retail operations for £346 million to the US motor dealer Group 1 Automotive. The business employs around 3,600 people in more than 80 sites and partners with car makers including Jaguar Land Rover, Volkswagen, Toyota and BMW. Inchcape, which will return £100 million worth of the sales proceeds to shareholders, said the disposal would leave it focused on distribution. The shares have risen by 3.25% this morning. The recruitment firm Page Group said today it had continued to reduce the size of its workforce after the slow end it had seen to 2023 continuing into this year. Well, the company said it had let go 100 fee earners during the first 3 months of the year, bringing the total over the last 12 months to 888. It reported a gross profit of £219.7 million for the first 3 months of the year. That was down 12.8% on the same period last year. The share's currently off by some 5%. And shares of Horizonte Minerals fell by as much as 84% this morning after the mining company admitted it had failed to find full financing to complete a nickel mine it's been constructing in Brazil. The company, whose second largest shareholder is the FTSE 100 commodity trading giant Glencore, said that despite nickel's long-term outlook being strong, investor sentiment had been dampened by low prices and a short-term surplus in supplies from Indonesia. It's now considering options including selling the project or putting itself into liquidation. Now, as more people look to decarbonise their homes, the residential energy services company HomeTree Group has emerged as a key player, expanding from initially offering home emergency breakdown and insurance to installing heat pumps, solar panels and electric batteries. Well, today it announced it secured a debt facility from funds and accounts managed by BlackRock that will enable it to step up its activities. It's also bought 2 renewable installation companies, which means it now has more than 5,000 installers, putting it in a position to take on the market leaders HomeServe and British Gas. Well, joining me now is Simon Phelan. He's Chief Executive of HomeTree. Simon, welcome to you. Why has adoption of renewable energy been so slow among UK households?
Well, I think it's a good question, Ian, and I think, actually, what we've seen since I've entered the category in 2011, 2012, the industries such as solar was very subsidy driven at that time. But positively, since Ukraine, we've started to see adoption rates of technologies such as solar PV really grow. So it hasn't all been negative, and we were seeing attach rates of batteries to those solar installations be quite high. But you are right that the UK in technologies such as heat pumps, for example, remains a real laggard versus other countries in Europe. And I guess there are many reasons why, but one of the major reasons I think is that unfortunately today, the way our electricity and gas markets are structured, the cost of electricity in the UK is significantly higher than the cost of gas because there's additional taxes and levies put into that cost. And unfortunately, that does just mean that it's less economic than we need it. So, we really think it's important that we try and get a level playing field so that we can really see an increase in the adoption of these technologies.
Nonetheless, you're pushing ahead with the installation part of your business. What will this new facility from BlackRock's funds enable you to do?
So at HomeTree, we say that we're building a full services residential energy services company. That means that we want to help homeowners install the core home electrification technology, help them finance that technology because that's a big problem for homeowners, but then in life also give them the peace of mind, the maintenance, the breakdown, the servicing. And we think that homeowners need that whole end-to-end to get the peace of mind to do that. But when we looked at this market, we had a large insurance business, we had a financing business, but we saw that the installation market is very fragmented, lots of really good, profitable, founder-run businesses installing solar heat pumps, but maybe that don't have the capacity to invest and offer finance and the rest. So what we've decided to do is ultimately to come in and acquire the best regional installation companies across the UK and put them together as part of a bigger group offering for homeowners. And this debt facility with BlackRock, alongside our strong equity backing from the likes of Legal & General, is really going to enable us, we believe, to build a UK market leader.
So you think the market's set fair for consolidation then?
We think that, the benefits for a hyper-fragmented category becoming a bit more consolidated. We believe there'll probably always be a long tail, but we do think that there are benefits for smaller, profitable, leading installation businesses becoming part of a bigger group that can help homeowners offer a more complete one-stop shop solution for their home.
I mean, this is quite a competitive market, though. I mean, we had the CEO of Good Energy on a couple of weeks ago. They're trying to do exactly the same as you are.
You're right, there's multiple players, but if you actually step back and think what's happening we're doing a once in a 100 plus year CapEx replacement cycle of traditional hardware in homes, be that gas, heating, etc. All of that needs to be upgraded in the next 10, 20 years if we're to hit government set net zero targets. And so we think that these markets are so vast. When you think 27 million homes, a significant portion heated by gas today, this is not a winner-take-all market. Multiple scaled businesses will be built in this space, and we believe HomeTree can be one of them.
You are up against some big beasts. I mentioned HomeServe and British Gas.
Absolutely, but I think that when you're so ingrained in as a legacy built around the gas network, we think that there is an opportunity for a technology-enabled, well-financed entrepreneurial business to come into this market. And look, it's played out. The acquisitions that we're announcing today, the Little Green Energy Company, GeoWarmth up in Newcastle, these are companies that had lots of interest from some of the names you've mentioned and other companies, but they've chosen HomeTree because we believe that rather than just being acquisition 421, part of HomeTree, they can come into an entrepreneurial organisation and get access to products and services that other organisations aren't offering them today.
And do you give these owners skin in the game? How do you incentivise
Absolutely.
them?
This is not we take the keys on day one and say thank you very much. Our model is to incentivise and empower great entrepreneurs and founders to stay with their business and to both hopefully crystallise some value that they've built over the last 5, 10, 15 years, but have targets over a 3-4 year period, but also to get some upside in the HomeTree game, because if they win, we win, and therefore we should all be in that kind of reward pool together.
Do you worry about there being a skills shortage in the sector?
Absolutely. If you were to ask me some of the things, apart from trying to get parity between the cost of electricity and gas, we need to attract more talent to this category. For whatever government is in government in a couple of months' time, there's a lot of talk about AI destroying jobs. We think it's probably a long while away before an AI installs a heat pump. And, these are going to be well-paying jobs for tens of thousands of people, and we need to attract, retrain existing gas engineers and get more people into the category. And that's why we think coming together with HomeTree, that already has a big network of 5,000 engineers, we can really help these businesses on that side with recruitment. And so that's the other benefit of being part of a bigger group.
OK, Simon, we're out of time, I'm afraid. Good to talk to you this morning. Thank you.
Vin.
Well, as I mentioned earlier in the programme, the oil price has largely shrugged off Iran's attack on Israel over the weekend. Here's what a barrel of Brent crude is doing right now, currently changing hands at $89.70 a barrel. That's down just over 0.4% since Friday evening. Well, on the foreign exchange markets, I'll show you how the Israeli shekel has done. That's risen, actually, by 1.5% against the dollar, rather confirming what Henry Allen was saying earlier on in the programme. The shekel did sell off last week amid concerns that an attack by Iran was imminent. If you look at the other major currency pairs, well, sterling's up by 0.25% against the dollar. It's up by 0.1% against the euro. The single currency, meanwhile, up by a similar amount against the greenback. Over on the equity markets, well, as I mentioned earlier, stocks in the Asia-Pacific region had a largely downbeat session overnight. Only Shanghai managed to buck the trend. But in Europe, well, stocks have traded largely to the upside this morning. Only the IBEX in Madrid letting the side down. Talking points today include GS, the Belgian insurer, which recently abandoned a takeover approach to the UK's direct line. That is currently ahead by some 3% after the French lender BNP Paribas bought a 9% stake from China's Fosun Group to become its biggest shareholder. Well, here in London, the FTSE 100 is in negative territory right now, off by 0.2% or so. The oil majors BP and Shell have accounted for 24 of that 35-point reverse so far on the index on their own. Outside the FTSE, the outsourcing group Mighty is up by some 7.5% following a trading update, while the house builder Crest Nicholson, that's ahead by some 4.75%, now 4.5% after it received a push from one of the brokers. Well, joining me this morning is Russ Mould, Investment Director, of course, at AJ Bell. Russ, good to see you this morning. You've been watching the dollar very closely through the last 48 hours.
Yeah, it's something that you would expect investors to perhaps to look for if there is geopolitical concern. And so the DXY or Dixie index, which is a basket of the dollar against 6 major currencies, including the pound, that's just nearing a one-year high at 106. So again, maybe a bit of haven hunting there, but also it comes back to how the US Federal Reserve hasn't cut interest rates as market expected. So if you can park your money in the world's reserve currency, get 5.5%, rather than 5.25% in pounds and 4.5% in euros and 5% in Canadian dollars, that's where people have been putting their money. So I think that's one of the big reasons why it's been the Fed not cutting. What that then means, the Fed is a strong dollar is traditionally disinflationary or even deflationary. It makes servicing debt more expensive for people, countries who've borrowed in dollars. A lot of emerging markets do that. And it makes commodities more expensive because they're priced in dollars. So watch for that one. But commodity index is still going up. So we'll see whether the relationship's going to break or not.
Indeed. Russ, just bear with me a moment, because I've just got a bit of breaking news to bring the viewers. This is a statement following police in New South Wales. A police operation is currently away in Wakeley following reports of a stabbing. Officers attached to Fairfield City Police Area Command attended a location on Welcome Street, Wakeley, following reports a number of people were stabbed. Officers arrested a male and he is assisting police with inquiries. The injured people suffered non-life-threatening injuries and are being treated by paramedics. We'll have more for you on the channel as the morning goes on that, I'm sure. Russ, sorry to interrupt you there. A lot of corporate news around today. Mighty was one that has stood out, really.
Performance from Mighty, day 17. The shares are the best performer in the FTSE All Share today. Very strong end to the year. A very broad spread of business there, but some of it may have been a bit of budget flush from government at year end, but still a very, very strong performance all the year round. Company is a big facilities manager, benefiting from decarbonisation, modernisation of buildings. So it's actually met its 3-year target plan, record profits, record sales, and a £100 million share buyback on top. So not too surprisingly, the shares are at a 7 or 8 year high today.
Yeah, very good performance. Real turnaround by Phil Bentley.
Fantastic,
the CEO
yeah.
there.
The shares were very much in the doldrums. Like lots of support services companies, in some ways it's shrunk itself down and focused on core competencies to get itself back to where it was before previously.
Yeah, well, talking of share buybacks, we've had one announced today by Inchcape.
Yeah, this is resulting, a transaction that we first discussed back in January when they flagged the preliminary sale of its UK retail business. Inchcape has decided that actually leasing premises or running them is tiring and expensive work. It would much rather be a distributor of cars, software, logistics planning, higher margin business, less capital intensive. So it sold the UK retail business, and for more than analysts were expecting, just under £350 million to a Texan firm. That money, a big chunk of that, £100 million, going back to shareholders. The rest of it on acquisitions. Interestingly now, no real business left in the UK, but I see on the Newswire the Chief Financial Officer saying, very happy to stay traded on the London Stock Exchange. Thank you very much. It's a great place to be.
Well, we shall see, won't we? Less good news from Page Group this morning.
Tough times for recruiters at the moment, and when a recruiter is cutting its own headcount, you know things are pretty tricky. So headcount down by around a 7th year over year. The first quarter continuing the weak trends that we saw in the fourth. All geographic areas down year on year, and temporary hirings now down year on year as well, which I guess if you're looking for any good news, the market's kind of expected this degree. They're already forecasting profits down for this year. And we're probably still looking at decisions taken by employers 3-6 months ago. There is a long lead time here in terms of either the horrid job of letting somebody go, because you have to look after them and consult with them, or the good news of when you're looking to hire somebody, you have to feel positive enough and bullish enough to do it first, and then go through that very laborious process of finding the right candidate. So we're probably looking at things that are still reflecting decisions taken when maybe economies were looking to turn the corner. Let's see if the next few quarters' numbers confirm whether we are or not.
Yeah, it'll be interesting finding out, won't it? Russ, got to leave it there, I'm afraid. Good to see you this morning. Thank you. Still to come here on Business Live. Levelling up, we'll hear from Mark Payton, Chief Executive of Mercia Asset Management, who will be helping invest more than £1 billion for the North and Midlands. Don't go away.
When you cover big, tense protests, there's almost always a moment when the atmosphere changes. There's a different noise, and you start to smell tear gas in the air.
As a team, we've interviewed some of the biggest stars in the world. Tom Cruise, Brad Pitt. It can be incredibly surreal being swept up in their world, but we try to give you an honest sense of how these people really are.
When we spoke to the fishermen down in Cornwall, all the politics from Westminster was a million miles away. This was about their jobs, their livelihoods.
Lazarus, and I'm Sky's reporter based in Delhi.
If you forgot your pajamas, Emirates has got you covered. Fly Emirates, fly better.
Welcome back. Sir Keir Starmer recently endorsed Boris Johnson's vision of reducing regional inequality via so-called levelling up, while accusing Rishi Sunak of killing the policy. Yet capital is being deployed in Britain's regions to support growing businesses. The British Business Bank has just launched its new Northern Powerhouse Investment Fund 2, a £660 million fund set to cover the entire north of England, and the Midlands Engine Investment Fund 2 that will provide £400 million of new funding for smaller businesses in the region. Well, among those mandated to invest the money is Mercia Asset Management, whose chief executive, Dr. Mark Payton, joins me now. Mark, very good morning to you. I mean, you've got mandates, 207 million, I think, for the Midlands Engine and 153 for the Northern Powerhouse. How quickly can you put those to use?
Yeah, so they're 10-year funds investing over a 5-year period. So there will be, but we went live with those at the beginning of this month, and we're investing already. So straight away investing. And put that in context, we invested approximately 220 million last year. We expect to go that up to about 250 million in this entire year across the funds we manage. And 90% of what we do, over 90% of what we do is outside of London. So those funds, that capital is really important to the North and to the Midlands.
Are there limits on what you can and can't do? Are there investments that are out of reach?
So historically, these are the second generation of funds. The first generations were constrained by a number of sort of EU restrictions. This is that first generation coming out that don't have those EU restrictions. So actually, these are a lot broader, so they can do quite a lot. They have limited restrictions in that regard, but geographical restrictions are their main restrictions to make sure the capital goes to work to those businesses that are typically employing less than 250 people, get access to that capital.
And what point in a company's life cycle do you typically invest?
Yeah. So, I set up Mercia back in 2010, and what I wanted to do is not focus on one bit, but the whole piece. So we'll do anything from very early, got an idea, maybe a first customer, up to it's a profitable business and it's looking to scale and grow. So we will invest from anything from £200,000 to 20 million across that entire growth journey of a business.
And as you say, most of your investments are in businesses outside London. What is the regional investment landscape like right now?
Yeah, so you can sort of divide the world into two things, actually, London and the regions, and private markets and public markets. And the private markets are really working well, very dynamic industry, very different to what we're seeing at the sort of small cap end of public markets. And outside of the regions, that again is very buoyant. So we saw, I guess, end of quarter 20 and beginning of 22, a real spike in terms of growth, and then that sort of leveled down. But actually, if you look in the regions, it's leveled down, but it's at a higher level than pre-2020. So actually, it continues to go well in terms of deals coming to us and businesses growing as well.
I'm asking you to generalise hugely here, but what sort of advantages do regional businesses have? Which are the sectors where they have a comparative advantage with ones in London?
So, and if I look at venture, half of what we do is in venture and half is in debt broadly. And if you look in venture, you have different sectors and cycles. We focus on life sciences, deep tech, software, and what we call consumer. And that really does play to the strengths outside of London. If you look at what's going on in London, fintech is a big push. That is almost unheard of outside of London. So those four areas, and life sciences at the moment, are really quite strong outside of London across the regions. You've got good universities, good expertise coming through. So that works extremely well in that arena. So quite broad, actually. You don't tend to get specialisms like fintech in London across the regions. In the East Midlands, you've got Bi-City, etc. So you do have a strong med tech piece there, but you tend not to get the clustering effects of what you see in London, Oxford and Cambridge.
Do venture capital firms too easily overlook the regions?
Yeah. So I set up Mercia on the basis of, finance and support is available on a meritocracy rather than geography basis. So back the best businesses wherever they are. What you find if you're in London is you can go and see everything on the tube. Well, it's a very efficient system. In the regions, you have to be physically there. So if you're a London-based house, the chances of you seeing the best thing in Leeds or Manchester or Preston is quite close to zero. So it's more inefficient. It means you have to be embedded in the community, and that means physically being there. We've got 11 offices across the UK, one of them in London, over 140 people, and they're based out in the regions.
And what about valuations? Obviously, things went crazy in 2021. It's been a little more depressed since then.
Yeah, and back to that two worlds of the private markets and the public markets, big correction in the public markets on a valuation front. There's been a more gradual correction in the private markets and arguably not quite the overreaction maybe we've seen at the smaller end of the public markets. There has been a tailing down, I think, in those businesses that needed a lot of money, and that money, put that into context, over the last 2 years, it's been a decline of a quarter to a third each year in venture capital provision coming through. Those businesses who needed a lot of money are really feeling a valuation burn at the moment. They're typically not regional businesses and typically not what we're exposed to.
And if I had to ask you for one particular region that excites you right now, what would you say?
Oh, that is like asking which of my two children are my favourites. So I'll answer that by saying actually they all work for different reasons. We think with these funds, the regional funds coming through, which are equity and debt, there is definitely the Midlands and the North to watch for because of the power of capital coming in.
OK, a diplomatic answer, Mark. Good to talk to you today. Thank you. That's it from me. I'm back at 4:30 with our afternoon edition. Do hope to see you then. In the meantime, stay tuned. Up next after this short break, it's Jane Secker. See you later. Cheerio.